Thank you, Chairman Lundgren, for that warm introduction. I would also like to thank the Economic Club of New York for inviting me today, and David Wessel of the Brookings Institution for joining us to moderate our discussion. Before I begin, I would like to remind everyone that the views I express today are my own and not necessarily those of the Federal Open Market Committee or of the Board of Governors, which set supervision and regulatory policy for the Federal Reserve System. In February, I announced that the Federal Reserve Bank of Minneapolis was launching an initiative to develop a plan to end the problem of too big to fail banks, and I committed us to releasing our plan by the end of the year. Today, we are fulfilling that commitment. I believe our initiative demonstrates the strength of the distributed structure of the Federal Reserve System that Congress created more than 100 years ago, which they designed to encourage a diversity of perspectives on important economic issues. The purpose of my speech is to introduce the Minneapolis plan to end too big to fail. I will give you some background on the development of the plan, describe what it accomplishes, walk through key steps of the plan, and then I look forward to discussing it with David and then with all of you in the audience. Now, this morning we published two documents. First, a summary for policymakers, and second, the full proposal of the Minneapolis plan. Those of you here in the audience in person have a hard copy of the summary in front of you. Both documents are available on the Minneapolis Fed website. I come at the too big to fail problem from the perspective of a policymaker who was on the front line responding to the 2008 financial crisis. When Congress moved quickly to pass the Dodd-Frank Act in 2010, I strongly supported the need for financial reform, but I wanted to see the act implemented before I drew firm conclusions about whether or not it solved too big to fail. Over the past 6 years, my colleagues across the Federal Reserve System have worked diligently under the reform framework that Congress established, and they are fully utilizing the available tools under the Act to try to address too big to fail. Now, while significant progress has been made to strengthen the U.S. financial system, I believe the biggest banks in America are still too big to fail and continue to pose a significant ongoing risk to the U.S. economy. Our initiative brought together a wide range of experts on financial crises and banking regulations through a series of symposiums in Minneapolis and Washington, D.C. By design, we wanted to hear all views. Some experts argued in favor of the current regulatory framework, while others argued for more transformational approaches. We learned something from everyone who participated, and we are grateful for their willingness to candidly share their ideas. Expert participants in our symposiums included former policymakers, such as former Federal Reserve Chairman Ben Bernanke, Vice Chairman Roger Ferguson, Governor Randy Kroszner. They included leading academics, such as Anat Admati of Stanford and Simon Johnson of MIT, among many others. They included policy experts from think tanks such as Adam Posen of the Peterson Institute and Aaron Klein of the Brookings Institution, and they included economists currently serving at policymaking institutions, such as Giovanni Della Riccia at the International Monetary Fund and Mark Flannery at the Securities and Exchange Commission. At every symposium, we invited the private sector to participate, and we were pleased to hear from experts across many segments of the financial services industry, including John Bavenzi of Oliver Wyman and Michael Hosenstab of Franklin Templeton. The largest banks, however, they refused to participate for fear that their participation would be viewed as an acknowledgement that the too big to fail problem still exists. We didn't allow their parochial objections to impede our work. Our goal was not only to learn as much as possible from those experts, but also to help educate the public about these important topics. So our symposiums were all open press and live streamed to the public via our website, just like we're doing today. I want to thank the members of the press who have covered and who continue to cover this initiative. Your work is essential to informing the public. All presented materials and videos of all symposiums are available on minneapolisfed.org. And as we have done throughout our initiative, we continue to see comments from the public. That is why we are releasing the Minneapolis plan with a 60-day comment period. The ultimate goal of our initiative is to equip the public and their elected representatives with the information and the analyses they need to assess what progress has been made in ending too big to fail, to understand what risks remain, and to give them additional options to enhance the safety of the U.S. financial system. Now, One of the key messages we repeatedly heard from experts throughout our initiative is the need to understand both costs and benefits when considering potential regulatory reforms. Indeed, as I will show you, an objective assessment of costs and benefits is the foundation on which the Minneapolis plan is built. One useful analogy that helps highlight the trade-off of costs and benefits is the risk of terrorism. Intuitively, the public understands that we as a society cannot eliminate all risk of a future terrorist attack. It is simply impossible to make that risk zero. And the public intuitively understands that physical safety isn't free. There are costs associated with hiring more law enforcement officers or installing more metal detectors. Since we cannot eliminate all risk, and since safety isn't free, we have to decide how much safety we want and what price we're willing to pay for that safety. The same is true for financial crises. We cannot make the risk of a financial crisis zero, and safety isn't free. Regulations can make the financial system safer, but they come with costs of potentially slower economic growth. Ultimately, the public has to decide how much safety they want in order to protect society from future financial crises and what price they're willing to pay for that safety. Now let me turn to our analysis. We've developed a framework for assessing safety and costs in the financial system. The first column says chance of a bailout in the next 100 years. The IMF has compiled a database of past financial crises from all around the world that we use to assess how frequently financial crises have happened in the past and what regulations were in place when those crises happened. Now, fortunately, financial crises are infrequent events, but that makes them harder to predict, like terrorist events or earthquakes. The IMF database contains the best data available to look at the history of financial crises and make informed estimates about their future likelihood. Now, we look at a 100-year time horizon because the Great Depression took place in the 1930s and the recent financial crisis in 2008, approximately 80 years later. Aiming to prevent financial crises over a 100-year time horizon seems to me like a reasonable goal, given how devastating they are when they do hit. On the right side of the table, we list costs. Here we calculate the present value of future costs in terms of GDP, using a similar method as regulators around the world use when they calculate their costs. So we set as a baseline capital regulations that existed in 2007 before the onset of the recent financial crisis. An examination of the IMF database of crises and the regulations that existed in 2007 implies at that time, before the crisis, there was an 84% chance of a crisis in the following 100 years. Now, obviously, the crisis, in fact, happened the very next year. The database offers a view of how likely crises are to happen, but it doesn't offer you a view on when they will happen. In terms of costs, we set 2007 regulations as a baseline, so that's why it's zero. It's our zero for comparison purposes. So next, we look at the capital regulations we have today, which have increased relative to 2007. As you can see from the table, the probability of a future financial crisis has been reduced from 84% before the crisis to 67% today over the next 100 years. That's a modest improvement in safety at a present value cost of 11% of GDP. Now, the question is 11% of GDP a lot or a little? Here we have, from the Bank for International Settlements, the consensus estimate of the cost of a typical banking crisis, 158% of GDP, which for the US economy equals roughly $28 trillion. This is the present value of the long-term effects of a banking crisis. Now, as we've all seen since the recent crisis, the US economy has been growing much more slowly than had been previously expected. These long-term effects are fairly typical for financial crises, which, as you can see, are extraordinarily costly for society. Against this enormous cost, 11% of GDP seems to me to be a small price to pay for a modest improvement in safety. Now, in contrast, the Minneapolis plan goes much further to improve safety, admittedly at an increased cost. The Minneapolis plan has multiple steps. I will explain what these steps are in a few moments. With step one of the Minneapolis plan, we can reduce the risk of a future financial crisis and bailout from 67% under current regulations to 39%, a substantial improvement in safety. And as you can see, the additional safety isn't free. Costs increased to 24% of GDP, which again is still small when compared with the typical cost of a banking crisis, 158% of GDP. Finally, in step 2 of the Minneapolis plan, we reduced risk further down to as low as a 9% chance of another crisis and bailout in the next 100 years. But again, the additional safety isn't free. The total cost is as high as 41% of GDP, which is much higher than current regulations, but still much smaller than the cost of a typical financial crisis. To say it another way, if the Minneapolis plan prevents one financial crisis, it will have paid for itself many times over. These are the trade-offs the public ultimately needs to understand to assess whether we have done enough to end too big to fail or whether we should go further. To me, these data make it very clear that we should go much further than we've gone today. Next, I will describe what's in the Minneapolis plan. So here I'm going to describe the 4 steps of the Minneapolis plan and compare them to the current regulatory framework. Step 1 of the Minneapolis plan dramatically increases capital requirements for all banks, bank holding companies larger than $250 billion to 23.5% of risk-weighted assets. And we count only common equity as capital. That is the key difference between our plan and current regulations. Current regulations also set 23.5% as the total amount of loss absorption that the largest banks must have, but current regulations consider long-term debt in that amount. We do not. History has shown that long-term debt is not useful protection against losses in a crisis. That's why we insist on common equity. Step 2 of the Minneapolis plan then calls on the U.S. Treasury Secretary to analyze and certify that individual large banks are no longer too big to fail. If the Treasury Department refuses to certify a large bank as not too big to fail, that bank will face automatically increasing capital requirements until either Treasury certifies it as no longer too big to fail or its capital reaches up to 38%. This is a critical step because today there is no time limit for solving too big to fail. Today, banks can enjoy their explicit or implicit status as being too big to fail potentially indefinitely. In contrast, the Minneapolis plan puts a hard deadline on Treasury. Certified banks are no longer too big to fail within 5 years, or else that bank will see dramatic increases in capital requirements. We believe this threat of massive increases in capital will provide strong incentive for the largest banks to restructure themselves so that they are no longer too big to fail. Any bank that remains too big to fail will have so much capital that it virtually can't fail. This is the approach our country has taken with nuclear power plants. People understand that if a nuclear reactor melts down, it is devastating for society. So we as a society had a choice. We could either ban nuclear power, which we chose not to, or we could regulate it so strongly that we've truly minimized the risk of failure. That's what the Minneapolis plan does for the largest banks in America. Step 3, impose a tax for debt of large shadow banks, greater than $50 billion, including hedge funds, mutual funds, and finance companies of either 1.2 or 2.2%, depending on whether or not they're systemically risky. One of the concerns many experts in our symposiums offered was the potential for risky activity to move from highly regulated banks to hedge funds and other shadow banks. If we just increase capital requirements on the biggest banks and all of the activity just moves to hedge funds, have we really improved safety? That's a good question. To protect against this scenario, our proposed tax will roughly level the playing field by equalizing the cost of funding between the biggest banks and the biggest shadow banks so that activity doesn't simply move to an unregulated part of the financial system. Importantly, shadow banks that are small or shadow banks that do not utilize debt funding will not be subject to the tax. And finally, step 4 rationalizes regulations of community banks, which are not systemically risky for the U.S. and that do have a vital role to play in the American economy. Banks with less than $10 billion in assets should be subject to a much simpler and less burdensome regulatory framework that reflects their relative lack of risk in the economy. Now, I know I have gone through these steps very quickly. We will we will go into them in more depth with David and in the discussion. And importantly, there are full details in the published materials, including the 50-page full proposal on our website. But let me turn back for a moment to how we estimate the probabilities of future financial crises, because this analysis is essential to evaluating whether current regulations go far enough or whether we should go further. As I mentioned, we utilize the best data available on historical financial crises, data from the IMF. This chart utilizes the IMF data to estimate the probability of a future bailout as a function of capital requirements in the banking sector. The x-axis are capital ratios. The y-axis are odds of a bailout over a 100-year time horizon. The black line that you see there has steps in it because it represents actual data from past financial crises around the world. Now, as I indicated, financial crises are infrequent events. That's why it's a stepped line. The red line is a smooth version of that same data which we use in some of our calculations. The blue star at the top of the chart indicates the regulatory system in 2007, before the crisis. Low capital, high probability of a crisis. The star a little bit down from it shows the current regulatory framework, with a modest increase in capital and a modest reduction in risk. The next star shows step one of the Minneapolis plan, with a larger increase in capital and a larger reduction in risk. And finally, the bottom star shows step two of the Minneapolis plan, with a dramatic increase in capital and a dramatic reduction in risk for the largest banks. Now, we know this is not an exact science, but looking at past financial crises is the best way we know how, or anyone else knows how, to estimate the effect of potential regulations in order to assess safety in the U.S. financial system. So what will the financial system look like after the Minneapolis plan has been fully implemented? We will have fewer mega banks in our country, and there will be far less concentration in the banking system. We expect that community banks will thrive, and mid-sized banks will make up a far larger share of the total banking system. The financial system as a whole will be much, much better capitalized and much better able to withstand a major shock without triggering a crisis. If there are any too-big-to-fail banks left, they will be so well capitalized that their risk of failure will truly have been minimized. Like terrorism, we cannot eliminate all risk of a financial crisis. But we believe the Minneapolis plan does a much better job of reducing risk at reasonable cost to society than current regulations. But ultimately, the public needs to make their own determination. We hope that this process will equip them with the data and the analyses that they need to make an informed judgment. Thank you very much. I now look forward to having our discussion.
Well, thank you very much, Terry and Neel. Thanks for inviting me to do this. I was looking online to see how this was being received, so I Googled Kashkari, and the first thing that came up was a story in the Minneapolis Star-Tribune which says, Kashkari's big challenge, not being ignored. So you're pretty good at marketing, and I don't want to overdo my advice, but have you thought about calling this the Ivanka plan to get a little more attention?
One of the wonderful things about the Federal Reserve is we pride ourselves in being non-political and non-partisan.
I see. Okay. All right. I was just doing the odds on your chances of getting attention, trying to move your curve a little bit.
I guess you weren't the optimal choice as a moderator.
So I want to start with some basics here. So the problem you're trying to solve is that if we have banks that are too big and they get into trouble, the government will have to bail them out.
Correct.
And you're saying that the best way to prevent that is to force the banks that are really big to hold so much capital that it's almost 91% odds assured that if they get into trouble, they will have enough equity to absorb the thing, and we won't have to have another TARP.
Correct.
That's the game,
That's right?
Okay. And you're saying that you're weighing the costs and benefits of your plan. So I want to talk a little bit about the costs and a little bit about the benefits. So the costs of this are that big banks will be forced to have a lot more capital. And you say in the 50-page report that this will raise the interest rates that people will pay when they borrow.
Correct.
Right? And you say, I just want to just dig in a little deeper on the costs in terms of GDP. You did a present value calculation. What would this cost us in GDP over the next 100 years? But if I read Table 4, page 22, correctly, you're saying that it would reduce GDP step 1 by 0.6% a year, and step 2, 1.4% of GDP a year, right?
So I don't remember what table 2, but I'm sure you're right. It's a permanent effect. So the U.S. economy will be slightly smaller than it otherwise would have been, and it's a permanent effect forever. And so what we do is we take a present value of what is the cost associated with that, and then we compare that to what's the cost of a financial crisis. So the numbers, the way we calculated the numbers is the same. So whether it's the 40%, the biggest number that I showed you in terms of the cost of step 2, that's an apples to apples comparison of the 158% of GDP that the Bank for International Settlements says this is the cost of a financial crisis. So we want society to win in the cost-benefit trade-off. Our analysis says if we were to implement the Minneapolis plan over the next 100 years, Main Street and our economy will be better off because we will have avoided some events like 2008.
Right. You're talking about us essentially buying insurance, right? And the premium we're going to pay on this insurance is higher interest rates, slower growth. And the benefit we get is less chance sometime, you don't know next year or 99 years from now, a less chance of a financial crisis.
That's correct.
Right? And the cost of the financial crisis is not measured in how much money TARP puts in, but in the lost output, the lost GDP, the damage to
the economy.
And
that's exactly right. And as I mentioned this in the remarks, as all of you have experienced, our economy has been growing much, much more slowly. Usually, when there's a recession in our country, the deeper the recession, the faster the recovery. But this banking crisis, it's been a deep recession, and then it hasn't bounced back. It's been a very slow recovery. That delta, that gap, if you take that present value forward, that's how you get the 158% of
right.
GDP.
That is, I'm sure you agree that. So we know at least some of that is due to the financial crisis, or probably other things. Right?
Probably other things, but if you look around the world at the history of financial crises, there are always other things. Like this keeps happening over and over and over again.
Right. Okay, so you're willing to pay this substantial cost in extra interest rates and lower growth and more unemployment because over time you think the benefits are greater in avoiding a financial crisis, although we don't know. We may pay the cost today and the benefits may accrue to our grandchildren. We don't know what.
Very possible.
Okay. All right. So then I want to understand a little bit about the benefit calculation. So first of all, how confident are you that this IMF database is really, it may be the best available, but we're, as you say, there are not very many financial crises. You're talking about, I believe you restricted it to developed countries, correct. OECD countries. Are you willing to take this as, are you so confident in this benefit calculation that you're willing to impose these big costs on the economy?
Well, here's the thing. This is not some mysterious existence of crises that maybe they happen. We know they happen, right? So we just went through it in 2008. We went through it in the Great Depression. I guess we as a country have to decide, is once every 50 years, is that acceptable? Once every 60 years, is that acceptable? Should we just shrug our shoulders and say, hey, let's just live with it and let's roll the dice? That's the call the American people ultimately need to make. So what we're trying to do is put the facts out there and say, if you think once every 50 years is acceptable, fine, let's stay the course. I don't think it's acceptable. I think the devastation from the financial crisis, we're still paying it, not just in terms of lost jobs and output, but I look at the polarization in the country today, and I feel like it is a direct outcome of the financial crisis. So we are still paying, and we may be paying for a long time in the future. If we can avoid these types of scenarios, my gut tells me it's worth to pay some insurance for that.
Okay, one of the things that surprised me a little bit, and when you had that nice chart showing how much have we reduced the odds of another financial crisis from the regulations we've done, you said we went from 84% to 67%. And I just want to explain a little bit about how you got to that number. As I understand it, before the crisis, the banks had about 4% capital, and after the crisis, they have about 13%. So we've done a pretty big increase in the capital of the banking system. Yet it seems to me to have had a relatively small reduction in the odds of a crisis. So again, as I understand it, you only looked at what effect does the extra capital have on. Now, for better or worse, we've done a lot of other things. We go have all these stress tests. We have a new way of regulating big banks. We have, again, for better or worse, at least for now, all the things that were in Dodd-Frank. Do you think all those had no effect on making the banking system simpler,
Look, I
safer?
think some of them have had some positive effects. So tougher liquidity requirements on banks are clearly a good thing. It's better if banks fund themselves with longer-term debt rather than funding themselves overnight. That's clearly better. Things like living wills and the complexity and this resolution architecture, it's anybody's guess how this is actually going to work in a crisis. Can you imagine if you were Scully trying to land in the Hudson and you had to pull this 10,000-page living will off the shelf and say, now I'm going to figure out what to do in the middle of a crisis? I don't think that doesn't give me a lot of confidence. We know that capital is a lot simpler. We know that regulators today cannot predict what new instrument Wall Street's going to invent in 20 years or 50 years. Capital is the only thing that can stand the test of time. And so when I look at how devastating financial crises are, I want to go to the simplest solutions, the ones that I have the most confidence will actually work regardless of the state of the financial system, and that's capital. And it's the only thing I can quantify. I would challenge anybody to quantify the rest of the stuff that's been done and tell me what the bailout percentage odds are.
But just because you can't quantify doesn't mean it's zero.
Okay, I'm with you. But I'll tell you this, the 13% that we gave credit of the current capital was very generous.
Right.
And so I think if people could push back and say we're giving way too much credit for the current regime because most banks don't have anywhere near that much capital.
Now, are you willing to, one way to look at this is capital is a substitute for regulation. So do you think we ought to dismantle some of the regulation in exchange for having the banks hold this much more capital?
I'm sympathetic to that view. I'm sympathetic that if the banks were truly well capitalized in real capital, equity, not debt, real capital, that you could then relax some other regulations because we'd have a lot more confidence that they have the resources to withstand a mistake.
So what would you get rid of?
Well, we talk about it for the small banks. For example, we've said for community banks, things like Volcker Rule, et cetera, they're subject to a lot of burdens that they shouldn't be today. But I think we'd have to look at it, on a case-by-case basis. The one that I feel most confident in is liquidity. I think it is important that banks fund themselves longer. That's a good thing. I wouldn't want to get rid of that. But I'd be open-minded about looking at other restrictions if I had real confidence that they had a high threshold of capital and it was there for the long term.
And we'd still need some kind of regime to decide whether a bank was systemically important. That doesn't go away because your whole system relies on the Treasury Secretary
making that
certifying
determination.
That.
Correct.
Right.
That's correct.
One of the things you mentioned in your, I like the way you said the summary for policymakers, which I thought was, the Minneapolis plan for dummies probably wouldn't have been a good marketing. But as I told you earlier, as a student of these documents, this one is admirably clear. Like I read it and I actually understood what they were talking about, which puts you in the top, at least the top 20% of these things, starting with Dodd-Frank, which. But you have a Q&A on this, and I'll ask you. So, it's very popular at the moment to restore Glass-Steagall. That is the Depression-era law that separated commercial banking from investment banking, and it seems to be a bumper sticker that a lot of politicians have. I'm not sure they could tell you what it is, but whatever it is, they want to restore it. You don't want to restore it. Why not?
I'm not opposed to restoring Glass-Steagall, but we don't think that it by itself would have prevented the 2008 crisis or would prevent a future crisis. So Glass-Steagall is trying to separate in pure play investment banking from commercial banking. Well, what we saw in 2008 is many pure play firms got into trouble. It wasn't just the combination of those two firms. And so
Bear Stearns,
Lehman Brothers, et cetera, AIG. So keeping these activities separate is not the most important thing. But again, I'm not opposed to it. Capital is the thing, making sure the biggest banks, whether they're investment banks or commercial banks, making sure they have enough capital is the best defense we know of against all sorts of future bad outcomes.
So the biggest difference, it seems to me, between you and the current conventional wisdom regime in Washington, at least before last week, is that you don't think that the banks having debt that might be converted into equity in a crisis is a workable solution. So that the 23.5%, that's a number that the Federal Reserve has said of total loss absorbing capacity that a big bank like JP Morgan should have. And you're saying, I don't want them to have 13% equity and 10% debt. I want them to have 100% debt.
Equity.
Equity. Why? This is something that you believe pretty strongly going into this thing.
Absolutely.
So explain to me why you think that all those wise men and women have it wrong. What is it that they...
So here's the thing. We all love the idea of being able to put a bank through bankruptcy. right? Like any other, like an auto company, like any other company. It goes through bankruptcy, equity gets wiped out, the debt holders get whacked, they become the new equity holders, the company moves on. That sounds great. The problem is, in a financial crisis, if we haircut the bonds of one bank, the bondholders of other banks get terrified that maybe they're next. And it's this risk of contagion across the financial system that is so devastating in a financial crisis. So I'll give you an example. 2008, I was literally in the room at Treasury when the Treasury Department made the decision to protect Fannie and Freddie subordinated debt. That debt had been issued, and the bondholders were told, if Fannie and Freddie get into trouble, you're going to take a loss. Well, in 2008, they were protected because of fear of contagion. This is, I have virtually all of recorded financial history on my side. People advocating for the current regime have hope and prayers on their side. And I'll take all of recorded financial history over hope and prayer. And I'll give you another example. These rules were put in place just a couple years ago. Already in Europe, they are being tested.
Deutsche Bank.
And Italy. In Italy, they're saying, oh my gosh, they're supposed to bail in these Italian bondholders, convert their debt to equity, but oh my gosh, they can't do it because retail investors. So now they want to give an exemption. Certain bondholders, you're going to be protected. In Germany, they're worried, is it going to lead to contagion? Within a couple years, this new policy has already been revealed to be a farce. Let's just admit it. Why do we want to bet our economy's future on the hope and prayer that this Rube Goldberg machine is actually going to work? Why don't we get rid of all of that complexity and just go with equity? We agree with the Board of Governors. 23.5%, you're right. That's the right number. Let's just make it equity and we get rid of all of this other uncertainty.
So what's the case for the other side, for using debt?
The case for using debt, and again, I don't buy this, the case for using debt, they'll say is, well, if you issue debt, it's less costly than issuing equity for the bank, and therefore the effect on the economy in terms of higher interest rates is going to be smaller. But this doesn't make sense because they're saying that you as investors are going to price these securities like debt, but they're really going to face losses in a crisis. You can't have it both ways. If this instrument is really going to be risky, you're not going to price it like debt. You're going to price it like equity. And if you really do price it like debt, that's because you don't believe it's ever really going to face losses. And so it's a little too clever.
Well, I mean, there are other arguments. One is that, of course, because of the way the tax system works, you can deduct the interest on
Sure.
the debt. But also, I mean, aren't the cat bonds and insurance companies issue like this? They're betting that there won't be a catastrophe. You're taking the risk that there will be.
Yeah, I'm not an expert in the in pricing catastrophe. My impression is a lot of these catastrophe bond markets work with government subsidies. They're very hard to price absent government subsidies. But I need to go look at that in more detail.
Let me ask you another thing about one of your metaphors. You have a couple good ones, the terrorism one, but I like the nuclear power one, where you make the point.
The banks love it when I compare them to nuclear power plants.
Well, I've observed with the cold, analytical eye of the former journalist that currying favor with the big banks does not seem to be on your utility functions. So, you make the point that the approach we've taken to nuclear power is the risks of a crisis are so great that we insist on lots of regulation, lots of redundancy, lots of shock absorbers, because we really don't want to have Chernobyl in Chicago. While not risk-free, they are so highly regulated that the risk of failure are effectively minimized. I think that's incontrovertibly true. It's also true that we've basically stopped building nuclear power plants, that we have become so risk-averse about nuclear power that we just won't have any. We won't build any new ones. Do you have any concern that if we did the Minneapolis plan and got all the way to step 2, that the effects on the financial system, on the flow of credit, might turn out to be worse than you anticipate?
Well, if it is, we change the policy. That's the thing. We live in a democracy. We implement policies. We see how they work. If they have unintended consequences, we can make changes. What I know is what we're doing right now is not enough. And I, for one, at a minimum, I want the public to be educated. I want everyone who's in this room and everyone who's watching at home to walk away from this breakfast saying, wow, there's still a 67% chance of another financial crisis in the next 100 years. Am I okay with that? I think most people would say, no, I'm not okay with that. We should do more. But that's a call the public needs to make. How much safety they want and what price they're willing to pay.
Is it, just to clarify, it's not really, you're not talking about the risk. We probably will have a financial crisis. I thought your goal was if we have a financial crisis, that the banks won't have to be bailed out.
Well, yes, but these two things are closely related. And so the 2008 housing downturn, in my opinion, turned into a devastating financial crisis because the banking system as a whole was undercapitalized. How are you doing? And then that led to an amplification and devastation for Main Street. If the biggest banks going into 2008 had Minneapolis levels of capital, we would have had a housing downturn, and we would have had a banking system that continued to function, continued to provide credit. And I would argue the recession that we experienced would have been far less severe than what we actually went through. So avoiding those types of scenarios and outcomes for Main Street, I think, should be the goal.
So another way to say it is we're going to have financial crises, but the point of this plan is to prevent them from turning into financial catastrophes.
Yeah, we're going to have economic shocks.
And transmitted by the banking
Correct.
system.
We're going to have economic shocks that hit our economy. Maybe, people thought Brexit was going to be a shock. We'll see. Maybe if there's a slowdown in China, that could be a shock to the U.S. economy. We want to avoid these shocks, which we know are going to happen, from turning into banking crises and then economic devastation for Main Street.
All right, let's talk a little bit about your tax on the shadow banks. So the argument there is if we make the banks hold a lot of capital and they have to charge more, that the money will just migrate to the shadow banking system, and all we've done is hide the risks in some dark corner that we don't know, and we'll discover that there's an AIG or Lehman of something that we don't even know that'll grow up to avoid the new capital. And now it sounds like a pretty big tax, but you said something that I hadn't picked up before. So if I have a mutual fund, right, and if I have a money market fund where I'm getting 0.2% return on, are you going to tax my money market fund 1.2%, or only a fund that has done a lot of leverage?
Only funds that use debt to fund their investment. So most mutual funds will be unaffected, but if a mutual fund goes out to either to its prime brokers or the debt markets to fund its activity with debt and levers up, and they're big, $50 billion or above, they would pay the tax. Again, a lot of hedge funds don't use leverage, but if they do use leverage and they're big, they're going to be subject to the tax. My view is this: if activity moves from the biggest banks in America to a bunch of little hedge funds all doing their own thing, I would argue safety has been improved. But if it all moves from JP Morgan to Citadel, then that's something we should be concerned about. And so it's targeted at the biggest hedge funds and mutual funds and finance companies that use leverage.
And the tax is on their borrowing or on their assets?
On their borrowing.
On the borrowing.
Yep.
So the idea is you want to, in that phrase of which I hate, level the playing field a little bit. That you can't, if you're a hedge fund, you don't have to have all this capital. You're not covered by the capital regime.
Correct.
But in order to make sure that you don't go off and do things that blow up the system somewhere else, I'm going to levy a tax.
And it roughly equalizes the funding costs, overall effective funding costs, as though we had imposed a capital requirement on hedge funds. We just think it's onerous from a regulatory perspective to go to all of these different institutions and say, now you have a capital requirement, now you have a capital requirement. It's just easier to implement by saying, here's a tax that roughly levels the playing field.
Relatively easier to implement.
Relatively easier to implement.
So what led you to conclude that you want the Treasury Secretary, a political appointee, to be the arbiter of who's systemically important and faces a higher tax?
That's a point of discussion. I think I don't feel strongly about that. It felt to me like having one person who's accountable to the president, who's accountable to the people, making that call. It's hard to get 10 regulators to agree on anything, and so at least you've got one person in a position to make a decision, and then we know who's making that decision. That person can be held accountable, and they'll be testifying in front of Congress and being held to account from Congress too. But it could be others.
Can we talk a little bit about the evolution of this and how it came to be?
Sure.
So you get hired as president of the Minneapolis Fed, and you decide not to take I think I'll take a year and a half to figure out where the men's room is, but I want to hit the ground running. And you picked this issue. Well, let me ask you, why did you pick this issue to focus on?
So first, I joined the Minneapolis Fed because I care a great deal about public policy. And I want us to have the biggest possible positive impact on the policy direction of the country. And so I went to all of my staff. We got wonderful people in Minneapolis, said, what are your ideas? What are the big challenges, the big risks you see? Let's hear them. And people put a lot of different risks on the table, and some people said too big to fail is still an issue. And I said, really? I think so too. Let's compare notes. And as we compared notes, we realized there's a lot more to do. And I said, this seems like a great issue to get going. Let's get going on it, and let's see where it leads us. And so I'm very happy with our team has done a phenomenal job, and we'll see where this leads.
And you noted in your opening remarks that the Board of Governors sets the policy on bank supervision and regulation, which of course is not, you're not a member of the Board of Governors. What kind of reaction did you get from inside the Federal Reserve System when they discovered you were going to do this?
A range of views. That's just some people.
We're not going to go get diplomatic now, Neel, after all these years.
Some people feel very passionate about the current regulatory system that we put in place. Other people called me up and said, and I quote, finally somebody is standing up and saying what so many of us know is true. And then they said, but don't tell anybody I told you I said that. And so, again, this is 100 years ago, Congress created a distributed Federal Reserve System with 12 regional banks. The reason they did that is they didn't want all the power in Washington and New York. They wanted it distributed around the country to encourage a diversity of views. So I feel like if we weren't speaking up about risks that we see and coming forward with our best analysis, we wouldn't be doing our jobs. And now we're putting it out there and saying, okay, everyone, you can absorb it, you can react to it, and you can tell us, no, we're happy with the current path, or we want to do more.
And as you know, maybe not everybody else says, one of your predecessors put this on the Gary Stern put this on the table before other people did.
That's right.
Well before the crisis.
Well, in 2004, Gary Stern, former president of the Minneapolis Fed, and one of my current colleagues, Ron Feldman, wrote the original book, Too Big to Fail, saying big banks were a problem and that these problems, we needed to address them.
So what happens now? You said you're going to have a 60-day comment period. So this is like a federal regulation where people can send you an email and say, you made a mistake, the second decimal point is off.
People have been sending us comments throughout the process. We've been hearing ideas. We want that to continue. And then we'll look at those comments and make changes if we think appropriate, put out a final version of the plan early next year, and then we'll see. I mean, I don't know. We're not in a position to lobby people. We're not going to go lobby, but we want to inform people. We want to educate people. Then at the end of the day, the public needs to decide.
So over this 10 months that you've been doing this, what did you learn that surprised you?
Just how complex the new regulations are. I mean, even trying to get your head around that 13%, you've got capital levels, charges, surcharges, countercyclical charges. I've never met anybody who can sit down, even PhD experts, and walk me through all of these various trinkets in this Rube Goldberg machine. Now, when you add that to the bail-in, add that to the resolution authority, the idea that all of this mousetrap is going to work in a crisis, good luck. No way. So simplicity is better in a crisis, and what we have now is not simple, not even close.
But you're building a system for the 100-year flood, and there's degrees of crises, and some of these things might work. I mean, I think.
Yes.
If the entire banking system is not melting down, we're better off with the resolution authority than we were when you were at Treasury in 2008.
I agree with that. That's an important point. So here's a big fundamental point. If an individual bank today runs into trouble, picture London Whale times 10, and it's very clear that it's specific to that bank, then there's very little risk of contagion because nobody's spooked that, well, the bank one had it, but the second bank doesn't have that problem. I think these Rube Goldberg tactics can work if it's that one bank at a time. But if it's a systemic shock, when all the banks are facing many of the same exposures, that's the really hard part to solve, and that's what we're trying to address with the Minneapolis plan.
And what would happen if tomorrow Congress adopted your plan, but the rest of the world didn't? What would happen to our banking system relative to those in the rest of the world? I mean, we would be at a disadvantage, right?
Yes, but other countries seem very they don't mind taking huge risks with their financial systems, right? In many other countries, their banks are their big national champions. And they say, yeah, we're going to bail out our national champions every 20 years or every 50 years. That's just life. Personally, I don't find that satisfying, and I don't think most Americans find that satisfying. And if we can show the rest of the world, hey, there's a way to have a vibrant financial system, a vibrant economy, without having the too big to fail risk in the center of it, maybe we can lead other countries and teach them to follow.
I agree with you wholeheartedly that, keep it simple, stupid. Mervyn King, as I recall, is promoting something similar.
Yeah, I read Mervyn's book, and I can't remember.
More narrow banking.
Yeah, it's more narrow banking, but there's some similar elements to it.
But on the simple basis of equity capital, forget the bells and whistles and haircuts and everything else, that seems to be the simplest solution. I think you're right.
It is. Now, some people have gone much further and say you should have 100% equity financing or have no maturity transformation. So, you could have banks that just issue long-term debt to fund long-term assets. And then that's probably even more extreme than what we're doing here. We're saying banks do have a role in the economy. Banks do have a role taking deposits, making credit decisions, lending long. But we're trying to keep them safe as they're doing it. There's some others, I don't remember exactly what Mervin's proposing, but there's some others who say, no, get banks out of that business. If you want to invest short-term, if you have a deposit, that should just go into treasuries. And other lending should only be funded long. So there are some differences, but I think directionally they're similar.
First of all, my name's Charlie Rose, but I'm not the guy on television. But maybe I should interview you. Maybe I should interview you anyway. You're obviously attempting to manage credit and credit risk, but if for example, if you go back to the '08 situation, where there was obviously a large amount of the credit was derived from the mortgage sector, and if one asset class becomes challenged, even though you may have an adequate amount of capital from a regulatory perspective, whether it's 13% or 23.5%, if one asset class becomes that draconian, it could still wipe out a situation. So to me, it seems what you're not dealing with is the diversity of credit and where the stuff comes from, rather than purely dealing with the financial institution that facilitated this credit to the public markets.
Yep.
And I think what you're doing here is you're really dealing with the symptoms. I don't think you're dealing with the symptoms as much and the derivative of that, because if you went back to most credit cycles that I've been living through, only about 40 years, they derive from one specific sector. And that one sector creates the problem. Before that, it was the dot-com problem.
Sure.
I remember the energy sector of the 70s where people were lending crazily. So to me, there should be issues not just with respect to capitalization issues, but also with respect to the concentration of assets that a financial institution has and the effects it has on credit risk. That to me would be more issue, because the mortgage issue is a symptom of broader issues that have gone back historically. So I'm sorry for
It's okay. No. I appreciate that, and you're right. But I wish we could legislate wisdom, right? We can't. It's not illegal to be stupid, and we as a society, all societies, are prone to mass delusions. So the problem is regulators in 2005 and 2006, hey, housing was a great thing. Americans were living the dream. So what I'm saying is I would love to assume that regulators in the future are going to be wise, but let's start by assuming they're not. And I'll give you another example. Coming out of the crisis, everybody's eyes were wide open saying we need to look out for the next thing, next shoe to drop. I don't know anybody who saw oil going from 150 to 30. That's a heck of an economic shock, and it just happened and our eyes were wide open and we all missed it. So let's start by assuming that other things, we're going to misprice other asset classes in a big way. Let's assume we're going to misprice them, and then ask ourselves, can the biggest financial institutions in the country, are they strong enough to withstand that?
Thank you.
Terry, thank you. Baldas from BGD Holdings, Governor Kashkari, thank you. Very thoughtful observation. I'd like your thoughts on the following. Instead of approaching it from the standpoint that we cannot and should not have too big to fail and therefore have the exorbitant capital standard and a constrained way of life from the flow of credit standpoint, how about approaching it from the standpoint, fine, if institutions are big, and we have to bail them out, we'll bail them out. The consequences with respect to individual decisions, and therefore what you visit on individuals for their actions, if you significantly enhance that, it's a tremendous constraint on the human behavior. An example of that would be the Foreign Corrupt Practices Act's concept of strict liability flowing to a CEO who cannot say, if corruption happened in Nigeria in selling of Diageo's liquor, I am absolved because I am the CEO sitting out here in New York or in London. So one thought would be to approach it differently. This is not a conversation we are having, and I think human behavior, constraining human behavior through their meditation on the consequences of their action, would be a significant mitigant instead of approaching it purely from constraining by, a 25% shrinkage in GDP growth is a significant shrinkage.
Let me understand what you're saying. So if we had another Lehman crisis or AIG crisis, the government should bail them out, and we should put the CEO of those institutions in jail to discourage future people from doing that?
David, that would be one way to look at it. The way I'm looking at it is I give credit, a lot more credit, to human beings and how they act and why they act. By and large, they default on the side of being good and wanting to do good. So in other words, you don't get to a point in time when you are sitting on a bomb that is about to explode.
So let me give you, though, I hear you, and I'm sympathetic. I wish that could be an answer. The investment banks, Bear Stearns and Lehman Brothers, that ran into the most trouble, also had the highest ownership by their management teams of their companies relative to other banks. One would have thought that their incentives were well aligned to not take exorbitant risks and wipe out all their own equities. And so I don't know if that would do it or not. I mean, I think you might have to go to something like David is saying, which is, hey, you're going to jail if you need a government bailout, in which case you may see the very contraction in credit that you're trying to avoid because they're so worried about lending to maybe a somewhat risky borrower. So I'm not sure. I would need to think more about it, but it's an interesting idea. Over here.
How do you factor in...
Can you identify yourself?
David Wessel. How do you factor in the data relating to the S&L crisis? And there you have a diverse group of lenders, smaller for the most part, but all over the country, that focused on a particular asset class that created huge damage and bigger payout from the Treasury, I think, than probably resulted from TLAC at the end after the repayments. How do you factor in that data into the whole assessment?
Sure. Well, first of all, I believe the S&L crisis is included in the IMF database, so that data is in there. But second of all, the S&L crisis was very costly for the taxpayers. The good news is it didn't bring down the whole U.S. economy. There was never a risk that we'd be facing a Great Depression type scenario as we were facing a possibility in 2008. And so that to me also says if you have lots of either small hedge funds or smaller institutions doing their own things, it isn't necessarily as devastating as a handful of giant institutions at the heart of the economy. I think there's stuff that we should learn from the S&L crisis.
Larry Ulick, Exeter. Neel, your step 4 has the worthy goal of reducing regulatory burden on smaller banks, but how does that tie into ending too big to fail for large ones?
Sure, it is somewhat separate, but the issues I think are being woven together today. I think my assessment is across party lines, both sides of the aisle. I think there's will to try to relax regulations on community banks, and they're being caught under the same regulatory net that was created after the financial crisis. That net was created to try to address too big to fail. My sense is people are reluctant to pull any of that net back because they fear that it's going to be pulling it back on the biggest banks. So our view is if the biggest banks are capitalized well enough that people have confidence that we've addressed too big to fail, then now there's room to take the next step, which is rationalize regulations on community banks. So they're separate but related.
Patrick Fowles, and thank you for your presentation. You've spoken about the importance of using common sense measures, and I wondered if you'd compared the losses in the last crisis to the absolute size of the capital buffers you seem to want. So to give you an example, I think the cumulative losses made by Citi, the worst big bank explosion, were about $60 billion. At the moment, under the new rules, it has $150 billion of core equity. And under your plan, stage 1, that would go up to about $300 billion. And those ratios are roughly true for the system as a whole. So why would you need $300 billion of capital to cover a loss which, under a very extreme 100-year storm, was only about $50 billion? It seems an overreaction.
Well, we're just going on the data of history, and not just looking at the US, but looking all around the world. And by the way, so we did our analysis looking at the history of financial crises in OECD countries around the world. That's what led us to around 22 to 23% capital. By sheer coincidence, the Board of Governors, through their stress test models on the biggest banks, have concluded 23.5% loss absorption is what they need for their stress scenario. So we came to the same number as the Board of Governors through very different means, both in the 22, 23% amount of loss absorption So I don't have the numbers at my fingertips to come back to you to say what Citi's losses were, et cetera. But I find it very interesting that two completely independent analyses basically drew the same conclusion. The only difference is we don't count debt in our loss absorption, they do. But the overall level of loss absorption is the same.
I mean, if I can labour the point, the bailout funds put into banks by TOP were about $250 billion. Under your plan, the same group of firms would need $1.4 trillion of capital. So,
yeah. Again, I'd point you to the IMF database and say maybe the '08 crisis wasn't that bad. I mean, maybe that's even worse. You know, we should think about it could be a heck of a lot worse than '08 if you look around the world, and we need to, build a wall that's even taller than we've been talking about.
I think you ixnay on the build-a-wall stuff, Neel.
Thank you, David, for that. Yes, a flood wall. I was thinking Fukushima flood wall. Okay.
Hi, Roger Bliss at RBC. Could you talk a little bit, Neel, about the impact on growth? While regulation may or may not be the reason why we're kind of stuck in this sort of anemic response and recovery, what would your plan do in terms of a top-line pressure or lowering of growth trajectory, kind of long-term?
Well, the way our economists have looked at it, we don't think it would necessarily change the direction of the growth rate. The rate itself would change. It would just be a one-time shift down. So we have a big one-time shift down from the financial crisis. Another financial crisis would also have a big one-time shift down. This would try to avoid future one-time shift down by paying some insurance up front. Again, it's just a question that we as a society need to answer. Do we want to have frequent financial crises, have all the damage that comes with them, pay that price in terms of damage to Main Street, or avoid those financial crises and have a slightly less bullish, exuberant economy in some other states? And that's just a trade-off we could have. But what I don't want people to have, I don't want people to have a false sense of security that we've solved too big to fail. And we can, this cannot happen again, and let's just go on our merry way, because the data doesn't support that.
Eileen Atman, Belfer Management. Regulation by its nature is parochial. If we were sitting here in 2009, I think there would have been consensus that there was just too much debt, and today we have more. The mix has changed, so the aggregate public and private sector is much greater. If we adopt this plan 10 years out, and one of the effects is less debt, would you view that as a favorable outcome?
Sure. Yeah, I think so. I mean, call me a traditionalist, but I think less debt is better than more debt. Personally, and for a banking system and for a country, generally speaking, I think less debt is better. That's not the goal in and of itself here. It's a stronger banking system, but I think if we have a more capitalized and less levered banking system, I do think we'll have a stronger economic base.
But by definition, if we have a less levered and more, a better capitalized banking system, we're likely to have less credit in the system broadly.
Sure. No, I understand. One of the things that always surprised me leading up to 07 and 08 was every time I'd turn on the TV, it was always the consumer reaching up and printing GDP. And it was a miracle. And Wall Street was high-fiving. Yes, the consumer stepped up again, and the savings rate went down and down and down to zero and ticked negative. And just intuitively, I thought to myself, I didn't call it, but intuitively I thought, that's kind of weird. This can't go on forever. And we saw it didn't go on forever. And so, again, our plan passed a cost-benefit test. If you do the math, Main Street is better off if we avoid these devastating financial crises.
Hi, Stuart Plesser, S&P Global. Hi, Neel.
Hey,
thank you for the presentation. So I guess my question is, you have this 23% of equity instead of using the debt. I hear your arguments for the contagion aspects of converting debt to equity. I guess the point is, early on, are we just causing a contagion up front? 23% equity on a bank. I mean, the returns ROE for banks are about 9% right now. For the industry, which chop that down, would the market just leave the banks and they wouldn't have capitalization? Why would an investor go into a bank if this was their capital threshold from the get-go?
Well, the banks will probably end up looking very different. Keep in mind, let's just take a step back. I know we're in New York City. Most big companies in America have 30, 40, 50% equity. This 5% equity thing is unique to financial services. And they've convinced themselves and convinced the rest of us that they're very special that for some reason they don't need to have 30% equity like the rest of the world. And so, yeah, some banks would probably have business models that don't work. They probably already have business models that don't work, even given the modest capital standards today. That's not our problem from a policy perspective. Let them restructure themselves and come up with a form that investors can find attractive to invest in. Little banks can probably get away with it. I mean, how is it that some little banks can have higher capital than the big banks when the big banks have these huge economies of scale? The thing that's interesting about our plan is it allows the biggest banks, if there really are these giant economies of scale and scope for the biggest banks, they'll be able to afford the higher capital. If their customers really don't benefit that much from their scale and their scope, they won't be able to afford the higher capital. And then they can make the decision that they want.
Hi, this is Avneet with EIR. I want to ask you, because since the past year you've been deliberating on your plan, you've had the situation internationally and domestically has drastically shifted. You've had a popular revolt against no growth or low growth in the United States and elsewhere. But in other parts of the world, you've had a new paradigm shift with AIIB, the new Silk Road, the BRICS, these connectivity programs. So the necessity, I do want to bring up the issue of Glass-Steagall, because many of these non-banks did get various forms of funding in various forms of lines of credit from real banks, be it mortgages, purchasing agreements, et cetera, et cetera. So wouldn't a simple solution like Glass-Steagall be necessary? And also your comments on like United States joining the AIIB and this new paradigm.
Well, I'm not familiar with the second piece, so I'm not informed enough to comment on the second piece. Back to Glass-Steagall, I'll give you an example. So let's say, leading up to 2008, that Glass-Steagall had still been in place. So you had an investment bank that was buying mortgages, packaging them into mortgage-backed securities, and so they buy mortgages from the commercial bank, they package the mortgages into mortgage-backed securities, and they sell them off to the insurance companies and the asset managers, et cetera. That process can still lead to excesses. It doesn't have to be housed within one corporate entity for the bad actions, to either ignore how bad the loans were when they bought them or to mischaracterize them when they were selling them off to the insurance company. So separating those two out doesn't actually stop that bad behavior from happening. Again, as I said, I'm not opposed to Glass-Steagall. It would lead to smaller, less complex institutions, which I think is a step in the right direction, but I don't think it by itself would actually prevent future financial crises.
Good morning, Neely Gilbert from Matarin Capital. My question is about the models that you use to support your proposals. It strikes me that one of the major problems in 2008 was our inability to really model systemic risk events. You've pointed to some of the problems. Correlations go to 1. Mr. Wessel talked about the problem of limited sample size with prior events. Normal distributions don't work. The events don't fall along a bell curve. So I appreciate some of the realism in your proposal, and yet the proposal itself involves a lot of statistics underlying the specific targets. How can we have confidence in those numbers given all that we've learned? And what did your team do to adapt its approaches based upon the learnings from 2008?
Sure. So in the 50-page plan, which you probably don't have in front of you, but it's on our website, there are sensitivity analyses. So all of the assumptions that we make, whether it's loss given default, et cetera, all of the assumptions are laid out there, and we run different ranges to test the robustness of our proposal. If the world looks a little bit different, the outcomes end up looking different. But that's why for me, and I agree with you, all of those are legitimate, genuine uncertainties that we face, the world faces, because there's just so much data that we have available to us. But that's why I come back to capital is the one thing we know about that can withstand all of these mistakes that we can make and that the banks can make and that investors can make in mispricing things. Capital is that buffer. When you screw up, you've got this capital here to protect you. The question is, do we have a high enough level of protection? And that's been our approach, but we've been honest about where are we making assumptions and what are the limitations. I don't know. I don't have all the answers. I don't know how to do more robust analysis than we've done. And that's why we've engaged experts from around the world. We've opened ourselves for comments. We're still open for ideas if people have ways of improving on what we've done.
Morgan Harding.
Could you give us a brief civics lesson on which branches of government would need to take action to implement your plan?
Sure.
And also comment on a reaction that, given how much the political winds seem to have changed in the last week, and particularly, it's so hard to understand really what will be different. But one observation might be that the appetite for more regulation has declined. Is this report dead on arrival?
Well, I hope not. Let me answer the second question first, which is one of the things that has pleasantly surprised me when we came out with our announcement of our initiative in February. The response was bipartisan. We had experts at the Cato and Hoover Institutes, very conservative, coming out saying this is great, we need to do this. And we had Senator Sanders come out and say this is great, we need to do this. And so if you're uniting the far right and the far left, you're on pretty solid ground. So my hope is that there's interest on both sides of the aisle for this type of work and analysis. What would remind me the first part of your question? Yeah. No, so we think this would require legislation. Number one, what we are proposing is a major restructuring of our financial sector. That's a call the American people need to make through their elected representatives. That's not a call, in my judgment, regulators should make on their own. Number one. Number two, this process of forcing the Treasury Department to certify whether or not banks are too big to fail and then force those banks to face higher capital requirements, that would require legislation, as would the tax on shadow bank debt. That would also require legislation. And then finally, what we're trying to do is codify these lessons in law so that future generations don't make the same mistakes we do. Societies, including ours, keep repeating the same mistakes, but it's not usually the same people. It's usually our kids or our grandkids repeat the same mistakes. So if we can put this in law, my judgment is it's going to be a little bit harder for future generations to relax when everything seems great.
David and Neel, thank you very much for today. It was very, very enlightening.
Thank you, Terry. Really appreciate it. Thank you.